So the assessment year is a period of 12 months. It is standard. The assessment year commences on the first day of April in a year and ends with the 31st day of March of this subsequent year. Standard 12 months. Connected to the assessment year is the concept of the previous year. These two are the twin pillars on which the Income Tax Act stands. The previous year, as the name indicates, is the year immediately preceding the assessment year. So if I take a 12-month period as 1st of April 2020 to 31st of March 2021, which is the assessment year, then 2019-2020 would become the previous year, relevant to it. They are always in relation to each other. An assessment year is of a previous year. A previous year is of the assessment year. So previous year means the year immediately preceding an assessment year. That's why the word previous. Now, why are these two definitions made? Assessment year is given by section 2(9). Previous year is defined by section 3. Why are they defined? That is because of the measurement yardstick. Now I'm going to introduce the principle based on these two, that the income of the previous year is chargeable to tax in the immediately following assessment year, which is the relevant assessment year. So previous year is the year in which the income is earned. Assessment year is the year in which that income is assessed, determined, quantified, frozen, to decide the assessees, the taxpayers, tax liability, plus or minus. It might be payable by him or refundable to him. So every previous year has an assessment year, every assessment year has a previous year. And it's a cycle that keeps going on. A cycle which we commenced in 1962-63, where we saw that 1962-63 was the first assessment year, for which 1961-62 was the relevant previous year. From then, our Income Tax Act started. Of course, amended over a period of time, from time to time frequently. Since income earning, expenditure incurring is a routine cycle. Just like in accounting, in income tax also, there has to be a cutoff somewhere. That cutoff is 31st March. Indirectly, the Income Tax Act says, go on, earn your income until 31st March midnight, 12 o'clock. From 12/1, the assessment year starts. Because earning of income is a continuous affair. To decide a person's tax liability, I need to decide a particular period of time, a specified period of time. That is the previous year. So it is the income of the previous year which is assessed to tax in the immediately following assessment year, which is the relevant assessment year. So assessment year is the year of the government. Previous year is the year of the taxpayer. So for 2020-21 assessment year, 1920 is the previous year. For 1920 assessment year, 18-19 is the previous year. For 2025-26 assessment year, 2024-25 is the previous year. So it keeps cycling that way. So currently what is going on as of now? The assessment year 2020-21 has just started. And the previous year relevant to it, that is 2019-2020, is just over. Income earned by different taxpayers for the financial year, for the previous year 2019-2020, will about to be commenced in the year 2020-21, which is the assessment year. So whenever a date, a month, a year is given to you, you should be able to determine which financial year it pertains to. Forget about previous year and assessment year. For example, if I say October 2018, October 2018 is the financial year 2018-19. If I say February 2020, February 2020 falls in the financial year 2019-2020. If I say June 2017, June 2017 falls in the financial year 2017-18. So here we are dealing with a twin pair of financial years. One is the previous year and one is the assessment year. Now, whenever the concept becomes a little complicated to apply in a particular given situation, I would use the help of a diagram to show you the relationship between the two. This is how a financial year looks. Nine months of one calendar year and 3 months of the next calendar year. Let us say the 1st of April 2019 to the 31st of March 2020. This is how that financial year looks. Of course, this will be 1st of January, this will be 31st of December, this will be 31st December of 2020. So this is a financial year. What immediately follows would be the assessment year. So the assessment year will be from 1/4/2020 up to 31/3/2021. So this is the year in which the income is earned, or the income of the taxpayer, or the year of the taxpayer. And this is the year in which that would be assessed, which can commence only after this year is over or completed. So the idea behind defining assessment year in section 2.9 and defining previous year in section 3 is to bring up this principle of taxation, that income of the previous year is assessed to tax in the immediately following assessment year. And we must remember that this 2019-20 was the assessment year the last time, and this 2020-21 would become the previous year the next time. So a financial year plays a double role. It is an assessment year now. It will become the previous year the next time, or for the next year. So it is only a method of cutting off this income earning cycle at predetermined reference points of 31st March. Now look at the difference. An assessment year is always a standard period of 12 months. It can never be less than 12 months, it can never be more than 12 months. It's always a standard yardstick of 12 months, by definition. I repeat, assessment year is the period of 12 months commencing on the first day of April in a year and ending with the 31st day of March of the subsequent year. So the government's year, the year in which the income is assessed, the assessment year is always a standard. But look at the previous year. It need not be a standard period of 12 months for all. Imagine an individual joining up for employment on the 1st of June 2019. He joins a salaried employment, or a person commences business, or a company is newly incorporated on 1st of June 2019. Remember, the previous year has to end here. So then the previous year would be only from 1st June, which is 10 months, excluding April and May. Imagine another typical case where, let us say, a partnership firm is dissolved on 31st December 2019. Assessment year would start only on 1st of April 2020. So there is a partnership firm having a previous year of only 9 months. So the previous year may be less than or equal to 12 months, never more than. But an assessment year is always a standardized 12-month period. So the previous year depends on, if it's a company which is continuously in existence for the past 18-20 years, a person is in salaried employment for the past 15 years, then this is just another year. It is a full 12-month previous year period. But there could be cases like this, where a new source of income is generated or commenced. An activity giving a source of income is just commenced, or such an activity is just concluded in the financial year. Then the previous year need not be of 12 months, it could be less than 12 months. However, the assessment year is always a standard period of 12 months. So the idea behind defining them is to bring up this principle of taxation, that income of the previous year is assessed to tax in the immediately following assessment year, which is the relevant assessment year. Now, there are 4 exceptions to this principle. So let's identify the rule first and then the exception to the rule. We lay down the rules simply. The rule is that income of the previous year is assessable to tax in the immediately following assessment year. So, if I take the previous year as 1/4/2019 to 31/3/2020, its assessment year would be 1/4/2020 to 31/3/2021. Taking a normal case where both the previous year and the assessment year are both of 12 months each. The next year, this would become the previous year, 21-22 would become the assessment year, and so on, and so in the past. Now, this is the year in which the income is earned. This is the year in which it is assessed to tax. Now, there are certain exceptions to this. The first exception is the case of the shipping business of a non-resident without a permanent representative in India. A shipping business, a shipping company which is incorporated outside India, it's a foreign shipping company, a non-resident. Income of a shipping business which does not have a permanent branch office, department, division in India. Suppose a ship from the US, Washington DC, comes to Mumbai and arrives on 1st of October 2019. It lies there anchored for a month and leaves on 1st of November 2019. Unloading passengers, loading cargo, unloading livestock, etc. It is anchored there for 1 month and then leaves after reloading. If my assessing officer waits for the assessment year to start to tax the income of that particular ship or of the company from that particular ship, the ship would have reached back to Washington DC. It may become difficult to recapture that moment when income was earned in India. Definitely that ship would have earned some income in India. If I don't catch the ship or the captain of the ship then and there and levy or compute or collect the tax, it may never be recoverable later. So, in such a case, the income of a shipping business of a non-resident without a permanent representative in India, we cannot afford to wait for the assessment year to start. It has to be taxed then and there. So, income of the previous year in such a case is taxed in the previous year itself without waiting for the assessment year to start. Naturally, I have to carve out an exception for it. In the best interest of the revenue, because otherwise revenue for the government in the form of income tax will be lost. However, if this non-resident shipping business has a permanent representative in India, I don't have to apply the exception, I can apply the rule. Since I have a collar to catch. In such a case, the lacuna, the deficiency that the income tax department encounters is, you don't have a collar to catch. If you have a collar to catch, to collect the tax, you need not do the taxation then and there. Then I can treat that non-resident shipping business like a resident, like one who is in India. So in the case of the shipping business of a non-resident without or not having a permanent representative in India, income of the previous year is taxed in the previous year itself. That's one exception. The second exception to that rule that we have made up is the income of a person leaving India permanently or for an indefinite period of time. An individual is leaving the country for a relatively long period of time or maybe permanently. Unless he clears his income tax dues, he cannot be allowed to leave India. A very subjective term used here, indefinite period of time or indeterminable period of time, considerably long period of time. What is a long period of time depends on the situation, case to case basis. So even in this case, I cannot apply my rule that income of 1920 will be assessed only in 2021. Income of 1920 has to be assessed in 1920 itself before he leaves India. So the second case, income of a person leaving India permanently or for an indefinite or considerably long period of time, income is assessed then and there in the previous year. The third is the case of a discontinued business. Like the example that we took, let us say where a partnership firm is dissolved during the year. A company liquidates during the year. A proprietary business dies. The sole proprietor dies during the year. I cannot afford to wait for the assessment year to start. Let's finish the assessment. So sometimes the assessment is over even before the assessment year starts. So here, discontinued business, discontinued source of income of that previous year in which the event happens, is taxable in the previous year itself. The fourth is the case of businesses which are set up for short periods of time. A business which is set up only for a period of 8 months, 7 months, 4 months, a joint venture, a collaboration, an exhibition, a circus, anything which is set up only for a short period of time. It is similar to this case of discontinued business. It is commenced in the year, it is wound up also in the year. There is no point in waiting for the assessment year to start. Income of that discontinued business or that business which is set up for a short period of time would be assessed to tax in the previous year itself. And the fifth is a tax evasion measure whereby a person makes an attempt to alienate assets to avoid tax. If a person is trying to tank his assets, abandon his assets, sell, transfer, any person trying to transfer assets, alienate means to transfer, to divest. If there is an attempt to transfer an asset to evade revenue, to evade tax, I cannot wait for the assessment year to start. I have to catch this tax evasion mischief immediately. It has to be captured, it has to be assessed, and maybe tax, penalty, interest, whatever is recoverable from this person must be recovered immediately. So in these 5 cases, income of the previous year is assessable to tax in the previous year itself without waiting for the assessment year to start. But otherwise the principle is income of the previous year is assessed to tax in the immediately following assessment year, which is the relevant assessment year. So in these cases, the exception has an exceptional wording. It's worded beautifully in the Income Tax Act. Let me see if you can follow it at one go. In these cases, income of the previous year is assessable to tax in the assessment year immediately preceding the relevant assessment year, which happens to be the previous year itself. So here all the discussion is going on in terms of assessment years. So the income of the previous year in these cases is assessable to tax in the assessment year immediately preceding the relevant assessment year. Otherwise, income of the previous year is assessable to tax in the assessment year immediately following, which is the relevant assessment year in those cases. So we wind up with that for this time. Do follow, do subscribe to my channel. Thank you.